let's jump on in. I'll start with you, Ryan, and maybe just, for our audience and in basic layman terms, can you kind of explain a little bit more about how, equity works at large, and then we can dive a little bit deeper.
Yeah, so equity in its purest form is just the ownership stake of the company. There are different ways you can own a company, one through common stock, which is kind of the lowest on the capital stack. And then you have preferred shares, which generally has some money tied to it, and they get a preference over common shares. So in some sort of exit, they would get paid first unless certain thresholds are met, and then everybody gets paid at the same time. In creating a capital structure, there are various different things you have to figure out. One, how are you going to compensate your employees as you hire them? Creating an equity program for them, what it looks like. There are various standard ways to do it. Y Combinator is definitely one that most people go to. And then as you're having investors write checks and invest in your company, you want to have it so it's pretty standard. Anything that's not standard gets like a little bit more scrutiny than if you're following a standard. So in the simplest form, like I said, equity is just an ownership stake in the company.
Mm-hmm. Yeah, when you reference that Y Combinator kind of like template, is there any like a general kind of rule of thumb of, when you're looking at startups for their maybe first 10 hires, don't exceed 10% of the equity pool, or are there specific ranges that come to mind when we're thinking about different sizes of a startup's evolution?
Yeah, usually it's like, so co-founders are different and fall out of this. So if you have co-founders, you would split up the equity kind of at the earliest stage. And then as you add employees, generally it's about a 10% of the outstanding equity at any one point in time. That's the general rule. It can vary from that, up or down a couple percentage points, but generally speaking, it's about 10%. And then there are various different standards out there for who gets what level of equity, and generally it's more on the executive side. So there are executive compensation studies you can purchase to make sure you align with whatever the standard is. Are you Series A, Series B, Series C? What is your revenue? Are you pre-revenue? And so you have various different factors you can consider as you issue these equity instruments to your employees. And then there are general rules for the non-executive employees too. So, and you try to design programs where positions and titles get similar equity across, so there's no inequity across the board.
I think one thing, just for those who are really new to it, like the difference, a question I get a lot is like sort of the difference between options and actual stock, right? Because you're not, when you're getting equity, you're not actually getting stock in the company just yet. So maybe.
True. Yeah, you're getting an option to purchase equity in the future at a specified price that is done by generally a third-party valuation firm, unless you're way early, and then it's just whatever the par value is of the stock, which is generally like 1/1000th of a cent. So, but really it's a right to just to purchase the ownership equity in the future. So, if you're given an option with a strike price of $1 and the share price as you go forward is at $1, you may not exercise because you're not going to make any money. It's just cash outlay and cash back. But if it goes up to like $5 in the future, you might exercise that because you will be in the money at that point. And so obviously, if the stock price goes below the strike price, you're generally not going to exercise because you're not going to pay $1 to lose 50 cents. So,
and to even get to this point, right? On the back end, there needs to be this sort of company valuation, right? To determine, I guess, what the cost to purchase a share, like what's the company valued at?
Yeah. So usually a third party valuation firm will look at your forecasts, your prospects, if you have any revenue, your historical financials, if you have any, and then kind of who your investors are and how much money have you taken in. So generally speaking, the common share option price will be lower than the preferred price because the rights are less and there's more risk there. So you'll obviously benefit from that. And in general, I think most investors and definitely the founders want the strike price to be as low as possible while still living within the standards of the Internal Revenue Code. So.
Mm-hmm. And then there's also going to be these specific kind of vesting periods. Is that accurate?
Yeah, the standard vesting period for these options are usually there's a 1-year cliff, and then it's monthly after that for a 4-year period. So, they're not going to give you the options that vest on day one. They want your part of your earning those is to work at the company and stay there. And if you were to leave the company, you have unless it's for cause, you have 90 days in which to exercise those, or they forfeit back into the company pool and they can be issued to someone else.
Yeah. Yeah. Big picture. This is a talent retention strategy.
Yes.
You're trying to keep some key folks, especially in those early stages when you maybe don't have as much cash to offer to compete with more, larger organizations. This is that negotiating chip that you can kind of use to your advantage as a early stage founder.
It also helps align people, right? Like we're all trying to build this business. We're all trying to it sort of aligns objectives because if the company does really well, the stock price, that option is actually going to be worth something in the future. And as someone who is early at the company, you get to benefit from having participated in that. And that's sort of to counterbalance the fact that, right, maybe salary might not be able to meet the sort of market. So it's a little bit of a way to counterbalance that, in addition to being a retention tool.
So Nate, I'd love to hear it from your perspective when your experiences when first going into maybe negotiating your comp, including knowing that there's an equity stake at play. Can you explain like how some of that went down and was it clearly explained to you from the leadership? I'm always curious to hear how is it communicated during the interview process.
Yeah, I've had the chance to sort of be on the employee side of the table a few different times, both like with FANG companies and also with startups. I think that even though this is mostly focused on startups, it's worth a small shout out to the FANG company RSU structure, because I think that one of the big choices that we don't talk about enough is that employees will need to align their career goals and ultimately their retirement goals with where they're going to be working. And so if you want to think about it in simple terms, working at a FANG company is kind of the closest we have to the 1950s version of that really sure job. Like the RSUs come every 6 months. They have a pretty defined market value. It may float on the stock market. You're making a bet, it goes up, but the company is going to just give you that cash effectively. You don't have to buy it. You don't have to redeem it. On the startup side, it's a little bit more like looking at yourself and saying, I can make a series of bets, right? I'm making bets and I'm hoping that, to Ryan's point, that the stock rises in value and the equity will be worth more than my comp over the long term. So that really shaped my approach, right? Like at a FANG company, I was more like, okay, fine. Like, let's make sure I'm at market with the rest of my peers in the company. And the startup, it's a larger conversation. It's what is the valuation of the startup? What is the growth trajectory of the startup? How much confidence do I have in the founders? Because effectively, especially if you're coming in the first 10 employees, look at yourself like an investor and ask the same questions an investor would ask, because you should be getting enough equity that it will matter. And so you should be asking some tough questions about the structure of the cap table. You should be asking about how investors who are already in, maybe at the seed or the A round, view the company. And you should be asking about what kind of multiples need to be hit to get to money that matters to you. And so one of the things that stood out to me this week, for example, there's been a lot of talk, certainly in my circles, around inflated valuations and the market getting tougher in the last 2-3 months. And a graph that really popped that out to me was someone took a bunch of really hot startups, graphed their average comp, graphed their average options issue, and said, for the average options issue, which is typically $50,000 to $60,000 on the face, what would it take to hit $1 million? So if you multiply it by 20, what would it take to get that sort of $1 million home run that a lot of startup employees want to receive? And the answer were ridiculous valuations. Like some of these companies would have needed to hit $600 billion for that to come true. And they're just not going to. And so I think that sort of serves to call out the importance of understanding the larger company context in order to make smart decisions about what to negotiate. Because negotiating for a bunch more money on the face doesn't make as big a difference if the multiples aren't there.
I think that's a great point. I think the other thing that I think about a lot is sort of the transparency as well. I can't tell you, I've talked to any number of startups and how open or closed they are with answers to those questions is a big factor because, right. I mean, if you're not getting the answers, how can you really make an informed decision? And, it sort of belies what might be some underlying problems in the future.
Well, yeah, the transparency is huge. And, one of the main questions as an employee to ask is, what is my percentage at stake in the company? Because frankly, the number of options means little, because if you don't know what the total options or what the denominator is, then it doesn't really give you an answer. And the companies that are the most transparent around their cap table and what their percentages are the ones that are the kind of the best, and you're going to live up to the transparency as they grow. Obviously, you can't share every little detail, but you can get answers and you can make an informed decision. And there's been places in the past where I've had the discussion and some have said, I'm not going to tell you, and then you just go away and say, this is not for me. Or they've been very transparent and it's not enough, and you have a different kind of discussion at that point, or you're like, oh, that's great, that's way more than I thought. And so you kind of make a decision based on that. And I think transparency is so big in the startup world, and there's so many people that like to hide things and or at least not tell you, and it's a red flag.
And if you can get to that percentage point conversation, and if you're happy with the multiples on the table, a good rule of thumb that I like to use is to negotiate for your dilution when you want, like everyone's like negotiating and they're going to be wondering, like, what do I put on the table? Well, what I do is I look at it and I say, look, I'll probably lose 20 to 30% of the value if I'm coming in at a seed or a series A, just in dilution from other people coming in later, if this is successful. Why don't I ask for 20 or 30 more % on the equity so that I get back to where I started? And I don't actually, like roughly speaking, right? And I don't actually lose traction as we go through the growth curve. And I find that especially if that is roughly in line with kind of where the band is for your job role, that helps you to argue for a little bit higher spot in the band. And can show that you're a savvy negotiator, right? Like you're someone who's been here before, or you can give the impression that you understand what you're doing. And that can lead to a more productive conversation.
Yeah. And further to that point, there are some companies out there that may not do that right away, but they have a program to give you boxcar grants or plus you up when there's a new round, or other ways to kind of mitigate against that dilution risk. You're not going to ever be fully back to where you were, just because it's hard to do that over time. Even investors that write checks generally from A to B, unless they're going to continue to lead rounds, generally are diluted at some level. So having the understanding of what the company does on a historical basis is very important. One of the companies that I work with does boxcar grants every year as it relates to the annual increase too. So they give you another year worth of options that then start vesting after the final vesting dates of the ones you already have out there. So just kind of another retention tool to keep you out there, but give you, keep increasing your percentage.
Yeah, I've seen way too many times, founders or CFOs that are, doing aggressive hiring and recruiting, but just being very vague about, equity and not just kind of deferring those conversations. And I understand you don't need to be so forthcoming in maybe the earlier stages of the discussion, but as things evolve and you're getting into, some final rounds, the longer that you hold out on that information, it's not going to play to your advantage. Just no use in hiding it. Figure out what is it going to take to solidify this hire, and if it's not enough, then it's not enough. And I will say too, like Ryan, I'm curious to hear on like, is there a framework that you advise or founders kind of play into for those key hires or those different levels within the organization, even though that might be very difficult early stage. But it's like, here's our, senior / principal folks that we know that we need, carve out this kind of, band. And then for, mid-level and for junior folks, is there a framework that most folks follow?
And yes and no. I think it depends on the business too, where they are, how many employees they have, what their valuation is, how many options they have available. So, because generally speaking, the founders and CEO don't want to go back to the board and say, "Hey, we need more options," unless you're in this like in between stage and you're printing money and you don't need to go raise more, and then at that point you might, add some more options. But generally speak, there's a couple. It's more that's an HR question. There's some firms out there that you can go buy studies for $10,000 or whatever, and have like a framework. There's, as long as you write it out and live within the bands, you're going to be generally fine. I mean, most people aren't going to give like a software developer, a junior software developer, a 1 percentage point in the company. That's just not the way that it works. And they're going to get somewhere between like 0.1% and 0.15%. And there's a general rule kind of there that I have experienced, and that's how I would advise just based on my experience. But if somebody wants something written out, they're going to have to go pay for a study. I don't have those.
I think one of the techniques to stand out in a world where, to Ryan's point, you have fairly standard bands, like what he's talking about is absolutely on the money. Like a 0.1% is really standard for a junior developer. You can still stand out by putting a little bit of variance into that equity offer, like say 0.1 or 0.12, and then vary the cash with that and give, like, what we like to do is we like to give folks a choice. Like if we're at the final stage, you can say, do I want a cash weighted offer or do I want an equity weighted offer? And giving that sense of agency can go beyond transparency to actually give someone a sense that they could be more bought in if they wanted to. And giving that choice, I think, has been really, I've seen people's eyes light up when they have that sense of being able to choose. And I will tell you, they don't always choose equity. Like sometimes folks choose cash.
Yeah, I think I was just going to say, Nate, when I do the same things, sometimes, there's life circumstances, right? Like, I don't know, I have to pay the rent and I have to put food on the table. So I'm going to go, so there's definitely those things that come into play. And I think giving people that ability to choose is great. I've done similar things. I'm curious, when you do have someone who's coming in and maybe they're a little more senior, maybe they are a principal engineer, that this person, whatever, their principal, they're going to make a real difference. When they ask for more equity, like maybe it's a loaded question, but I'm curious, like what your thoughts are when someone really is like, hey, I really want more equity.
Yeah, I mean, I've been in those conversations sort of on both sides. I've been the one asking, and because senior product roles can also ask for that. I've been, the one where like I'm in the hiring team. We're trying to figure out how to land someone. I look at it as a cost benefit, right? Like if you look at it and someone's saying, I'm really senior and I want another 0.1%, or I want another 0.2%. You look at it and say, are they worth a developer? Are they worth 2 developers? Is that the kind of multiple they're going to bring? Because that's effectively what I'm trading down out of my pool. And if the answer is yes, then maybe you have that conversation and maybe you say, okay, like we're going to weight it down a little bit on cash and we're going to give you what you're looking for. And if the answer is no, that actually tells you a fair bit about how much conviction you actually have and where their upside and slope are. But if you look at it that way, it helps you to make that trade-off because that's effectively what you're doing. Like to Ryan's point, you have a fairly static cap table, right? Like you don't really have a lot of room to just go print options. So you're stealing from Peter to pay Paul. And even if you haven't like met Peter yet, right? Like you don't know who this future developer is going to be. So you're essentially having to say, given the talent bar we've seen coming in across the company, would I be okay with delaying hiring an engineer for 6 months or a year because this person is that amazing?
Right. And I think that's a really interesting point about it's a zero-sum game, right? You have a set number of options. And I think a lot of startups I've seen where they sort of get into problems where maybe they gave out a little too much too early to certain people. And now they can't really attract the person they need because they just don't have the equity to do it. And they've put themselves in sort of an unfortunate position.
Yeah, that actually becomes like, I've seen that firsthand when like companies get later, like Series C and onward, you get into a situation where some of the early employees have sucked up a lot of the cap table, and you're fighting with really big companies now because you're like a 500 person company now or whatever. You can't really make we're a 20 person startup pitch anymore.
Right.
So you kind of have to put money on the table. And it creates all sorts of downstream issues because you're either going to commit a lot more of your cash budget to pull people in the door, or you're going to print options, or you're just not going to get the kind of quality of talent that you got when people were like, I'm in the first 10 and I make a big bang.
Yep, completely agree. And sometimes if you really have like a hot, let's say you're a company and you're a Series C company and you really need to hire, you realize you need to hire like a really senior person, like a chief operating officer or chief marketing officer, and you might not have the bandwidth in your stock. You might have to go hat in hand, and I mean that dilutes everybody, right?
Mm-hmm.
Who gives that up? Everybody, or just certain investors, or what? And so, having the discipline at the early stage is something that is hard for people to understand, but it's so important because especially if they're in the money and they exercise those options, if they were to leave, there's nothing that you can do about it because they're effectively not in the pool anymore. So sometimes you get lucky and you hire VPs of sales that last 9 months and then all the options go back into the pool, or that happened a few times, right, Mike? So
yes.
So, I mean, sometimes you get like, sometimes you don't. And sometimes people, one of the other things, especially early stage, pre-revenue, pre-Series A, like when you're in a seed stage, is for employees to think and ask about a early exercise option, which is a Section 83B election. It is something that allows you to exercise your options on grant, and you can start your long-term gains holding period. And from a capital gains perspective. And so that's something that also you can kind of try to negotiate. Most plans allow for that. Some don't, just because it would set a precedent and they don't want to have that precedent, but other times they do, especially when it's like, 1/1000th of a cent, and you get, 1% of the company, it costs you like $2 to exercise your options. So even if the company goes anywhere, most people aren't really worried about losing $2.
Right.
So
I think that gets into the whole tax thing, which is a whole nother. I think that's
a different podcast.
It is. It's a totally different podcast, but it is something I think as someone receiving the options, something I can't emphasize enough. Like I've gone through it. Like I was in the .com of the 90s, and I remember like a year after after one of the companies I was at went IPO, and talking to an accountant, and he comes in and he's like, well, the good news is you're not going to jail. The bad news is you owe a lot of taxes. It's like, and just sort of all of that stuff and understanding some of the tax implications, knowing like the whole exercising the options and holding them for a period of time, and understanding what that is. Yeah, it is a whole nother. I was joking with Tim before the podcast about how like looking at our tax code is like debugging somebody else's code from like high school. It's almost impossible to understand.
Mm-hmm. Yeah, and if you're going to exercise options, even if they are incentive stock options and you're an employee, you still should go talk to a tax advisor, because mm-hmm. there's instances where you could end up having to pay tax on the exercise.
Yes.
And so that's important for, that is not something tax advice. I'm not giving it, but like go talk to somebody to figure out what your position is, because there are instances where you could owe a crap ton of money and you don't have cash flow to match it. So just something to kind of consider too. So
yeah, that's one of the dark secrets of the tax code, is that the IRS will charge you for options that have appreciated. They call it the bargain element. And so if you have $1 options and they've gone up to $5, that $4, the IRS sees as income to you, even though you don't see a cent. Right. Which is really like, it's something that's got deeper issues with the way we allow employees to access equity. I think I get really passionate about this because I don't want to make it harder for people who are trying to build wealth to sort of build that wealth. And I think that that's one of those things in the tax code that actually acts to keep people from getting into equity and sort of building wealth for their families.
Yeah, and I think, I mean, a lot of that, as it is, it's another podcast, but I think there's historical reasons why that was, and who was supposed to be getting those options, and then the tech companies really changed that around and started giving it to everyone, and that's what really caused a lot of, I just remember all the stories in the 90s of some of my friends who thought they were in the money and then suddenly had to sell a lot of shares in order to pay the taxes on the money that they hadn't yet realized. It was like these crazy scenarios
it's
of
a circular reference.
Yeah.
So
what about any other options out there for for startup founders that maybe aren't looking to divvy up equity up front, but it's like profit sharing or phantom stock, maybe keeping it a little bit more clean until there's a better understanding of what this business is actually capable of.
Yeah, that comes down to the entity structuring. Like if you're a C corp, this is a regular corporation, you're pretty much going to issue stock options.
Mm-hmm.
You can do restricted stock units, which just are a right in the future, and they have a vesting period, but then the stock is yours after the end of that vesting period. If you are like a limited liability company, you can do profits interest, where you're only going to give out money if you're on an exit. They would have a vesting period, and generally speaking, I've seen those where you might get like 50% vested, and then then it doesn't vest anymore until an exit, and then you get everything. But if you were to leave the company, you only have that 50%. And so those are different, and it's a different structure. And generally, those are done by private equity firms because they have pass-through entities throughout their entire structure, where you would get a K1 potentially at the end of the year with like nothing on it because there's no exit. But as an exit happens, you would get like a windfall of cash and then have to pay tax in the future. So it just varies, but there's also like hurdle rates that you got to meet, and private equity structures are way more complicated than what we're talking about here. Again, another podcast in the future. For startup equity, I think it would be very odd to not have an option pool and an option plan. There's everything under the sun in the document that you can issue: restricted stock units, options, future appreciation rights, all the things like that. But generally speaking, if you're not standard, then people are going to wonder why.
Mm-hmm.
Especially as you go to raise money, like at early stage, like seed, and you have an option plan. If you have something different when you raise your Series A, the investors are going to be like, what were you doing? What were you thinking? This isn't what we do. Because the term sheets generally you have to have an option pool. Here's the pre-money valuation. Here is the options have to be, factored into before I buy my shares. And, and it really comes down to economics and control at that point. And so, but the new investor is not going to be hurt by plussing up the option pool to get to the total number of options for that total capital. So.
It sounds like we have some follow-up episodes here. Well, real quick, like Nate, can you do a quick recap on those items that you mentioned that you're, as a candidate coming into an interview process, totally. Some of those things that you think you'd want to clarify?
Yeah, like this is like the advice I would give to young Nate, right? So you want to first off understand, like I think Ryan's done a really good job describing what an option is and how it's different from stock. You need to understand that to understand anything else. So make sure you sort of read up on the Wikipedia article or re-listen to this podcast and have that solid understanding. And then at that point, you're ready to have a conversation about first, like the equity on the table for you. And then second, you're ready to do your own research and have a larger conversation about valuation, right? Because what you first need to do is say, am I willing to get into the pool and make a bet at all? If I get into the pool and make a bet, is this the right amount? And is this the right startup to make that bet with? Like those are all things you have to like talk through and understand. And the key factors are understanding like, is your equity benchmarked appropriately for your role? That's fairly transparent. Is the startup at a valuation that you think is reasonable to get to your financial goals? So you have to think about your financial goals. Do I want to buy a house with this money someday? Do I want to sort of buy my vacation home? Do I want to retire on this money? I don't know. But you have to think about what you'd like to do in a best case scenario. And then you have to think about the valuation multiples and say, is it reasonable to think that I could make progress toward that goal given the valuation that I'm getting in at now versus what would need to happen for that to unlock? Because the startup will talk a big game. Like, I've seen letters that come in that say, wow, imagine us as a $10 billion company. Look how much money you'd make. And they print it in really big font. And you have to sort of walk that back a little bit and say, okay, but what's it at now? Like, we don't know what the future holds. What's it at now? And then what is the capital market doing? And what are the valuations gonna look like in 2-3 years? And is that reasonable or not? Do I really buy that this is a $300 billion company in 5 years?
Right. I think that's the thing, is like, what makes you and this is, I've loved having these conversations with founders, like, or the hiring manager, like, what makes you think that number that you just quoted me is actually, like, what's the plan for getting there? And why do you think that that's a reasonable number? And if I buy into that, and I can't tell you how many times it's kind of both ways, where that number seems really outrageous and I walk away. And other times it seems like it's a really conservative number. Mm-hmm. And I'm like, wow, like, they're not trying to sell me on some fairyland. It's actually, this seems pretty achievable. So yeah, I think that's great advice.
Yeah. Good stuff. Any words of encouragement for, Netflix stock owners right now? No.
I remember Netflix in 2008. This too shall pass. Like, they were tanked.
Yeah.
Right.
Yeah.
Yeah, I mean, you have a whole slew of options that are out there for the streaming services. So it's like, at some point there's going to be more that, something's going to win. People are still, they lost a bunch of subscribers, but the weather's getting nice. People are going outside. So it's probably more of a cyclical thing than a Netflix is having a problem thing.
Yeah.
But I haven't read any of the documents. I haven't seen any of the press releases, but like, to me, I mean, especially as you're getting into the late spring and summer, people want to go outside. People have been stuck in their house for 2 years. It's there. The TV is great, but people want to go do stuff at this point and get out of their house.
It's a good point.
Like, watch cats jump in and out of cardboard boxes.
Yeah, exactly.
Drinking bourbon, watching cats jump through boxes.
Yeah, outside and while you're skiing.
The other piece is stop sharing your Netflix password if you have, because there are big rumors that they're going to fight this by cracking down on the 100 million shared password accounts.
Oh, yeah. Yeah, I heard about that as well.
Yeah, unless you have a family account, then it's okay.
Yeah, well, then it's
it's all within the same household.
Right.